Yes, ma'am.
Okay, girls, how much basic band is still remaining?
7,500.
Yes. Now the other gains are 13,300, out of which 7,500 covered in the basic band. Rate is 10%, 750. And how much gains will fall in the higher band? 13,300 minus 7,500. What is the answer?
5,800.
5,800 at the rate of
20%.
20%. What is the CGT payable?
That one is 1160.
And total CGT payable?
9860.
Any problem? Clear?
Yeah.
Okay. That's it. That is entrepreneurial, simple topic. Now, the next topic name, very important, takeover, or you can say reorganization. Paper to paper takeover, you can say. Paper to paper takeover. Takeover means simple. When one company acquire the 100% holding of another company. Takeover simple meaning is when one company acquire the 100% shares of another company. It means take over, the company take over another company, right? Okay. For example, Sajia has shares in company A. Okay. And now company B acquire the 100% shares of company A, means company B take over the company A. And you, Sajia, has company A shares, but another company acquire these shares. So it means all the Sajia shares also acquired by company B, right? So when you will give the shares to company B at the time of takeover, in return, which things you will receive? Okay. So at the time of takeover, a shareholder, in my example, Sajia is a shareholder of old company A, and the new company B acquired this old company. So Sajia's shareholding will also be acquired by the new company at the time of takeover. So when company B acquire these all the shareholdings of shareholder, in return at the time of takeover, the Sajia shareholder, which things she receive in return? Maybe she will receive the cash. Maybe she will receive the shares against shares.
Yeah.
Maybe she will receive the loan notes. Loan notes are also called debentures and also called QCBs. QCB means qualifying corporate bonds. Same name of the loan notes, loan stock you can say also. Okay, so debentures has 4 names: debentures, loan notes, qualifying corporate bonds, same thing. So in the time, at the time of takeover, you will get either the cash, shares in return, or loan notes. Now my question is, when Sajia will get these things at the time of takeover, what tax treatment will apply on these things at the time of takeover? Okay, so you can see the table from my notes. Open the topic takeover.
Yeah.
Can you see the table?
Yes.
In the table, there are 2 columns, received at the time of takeover, which things you are receiving, and the next column is tax treatment at the time of takeover. I am only reading it because when we do the question, these things will be more clear. So only I am reading it. Firstly, if Sajia will get the ordinary share or preference share at the time of takeover, what is the tax treatment? Next, tax treatment is new shares will be acquired at cost of old shares. What is this? Again, read it and tell me.
So they can purchase the new shares at a rate what was previously their gain.
No gain, no loss.
No gain, no loss. Very good.
Yeah.
Means, for example, company A, Sajia has all company shares, company A. And the cost of company A shares she has, for example, 20,000 pounds. Okay. Now company B acquired the company A. And when she received the shares of company B at the time of takeover, these new shares has cost of old shares cost. Okay. So it means
Yeah.
we can say the cost of old shares will be the cost of new shares. It means no gain, no loss arise. How no gain? I will tell you when we do the question. Next, cash. If she received the cash, what is the treatment? Calculate.
CGT.
Yeah. Oh, immediately you have to calculate the gain and charge CGT on that gain at the time of takeover. And third, if he will get the loan notes, below the loan notes, there is a line in bracket. Whenever you will sell the loan notes in future, CGT is exempt. You know, when you sell the loan notes, CGT is exempt. There is no gain, no loss always. No CGT on gain, no loss release on losses because CGT is exempt. But what is the tax treatment right now at the time of takeover when you are receiving the loan notes? At the time of takeover, calculate gain and freeze it. What is the tax treatment? Calculate the gain but freeze it. And what
So
is
later
tax
later
treatment
once
of?
yeah.
I will tell you the later on because I am just telling you the treatments. You have to
Yeah.
memorize the treatment, how to apply. We will do a question. Cash treatment is immediately CGT will apply on the gain. Calculate the gain on at the time of takeover and charge the tax. But loan notes gain, you have to calculate, but it will be freezed. Itself, when you sell the loan notes, the gain is exempt and loss is also exempt because CGT is exempt. Now write down a question. How examiner will test in the exam? Mr. A acquired 15,000 shares in JPLC at the cost of 3 per share in 1997. Next, in 2007, JPLC was acquired by A Limited. It means takeover, right?
Yes.
In 2007, takeover occurs. And at the time of takeover, it gives, new company gives. Next line, 5 ordinary shares at market value £3 per share. 3 preference share at the market value £1.5 per share. And next, cash £2 and QCBs, qualifying corporate bonds, also £2. Next line, for every 2 shares of JPLC. For every 2 means, for every 2 shares you are getting 5 ordinary shares. For every 2, 3 preference shares. For every 2 shares you will get the cash £2, and for every 2 shares you will get the £2 QCBs. Okay. Next paragraph. Letter in 2014, Mr. A sold 10,000 shares. Which shares? Ordinary shares. At market value £30 and 500 QCBs of A Limited at the market value of £8. Your requirement is calculate tax implications. Done? Girls?
Yes, ma'am.
Okay, now firstly I will tell you, examiner will when examiner will ask a takeover question in the exam, he will always start from the disposals. Means disposal story he will tell you firstly. Disposal story means examiner will tell you that the ordinary share you are selling in 2014, right? Just like that. And QCBs you are selling. Okay, firstly examiner will start the takeover topic from the sale. But my sequence will always be, when we start the takeover question, your sequence will be 3 steps. First step, you will calculate the old situation. Old means before takeover, how many number of shares and what is the cost of these shares. That is the first step. Second step will be, you have to take which new things you will receive, mean takeover occur, and which new things you have received. And third step will be the later disposal. These 3 steps you will follow in the exam. Examiner will always start the question from later disposal story. But my sequence of takeover is before takeover, which shares we have in the old company. Now, second step is takeover occurs and which new things we have received. And the third step is later disposal. Done? Okay, tell me, old, before takeover, which things you have received old, in old company? You have how many number of shares and what is the cost of these shares?
15,000 shares.
15,000 shares at a cost of
£3.
£3 per share. So what is the total cost?
45,000.
45,000. So that is a old step. Easy. So number of shares and cost you have to write down. That is old situation in old company. Now the new second step, takeover occurs. In 2007, takeover occur and which new things you have received? You have received 5 ordinary share for every 2 shares of JPLC. Already you have JPLC shares 15,000, right?
Yeah.
So ordinary shares you have received for every 2 means 15,000 divided by 2 multiply 5 is equal to
37,500.
these number of shares you received at the time of takeover, and the market value of each share is £3. So the total market value column you have to make, and market value is 112,500. Next, you will receive the preference shares for every 3 preference share. It means for every 2 means 15,000 divided by 2 into 3 is equal to
22,500.
these number of shares at the time of takeover you received at a market value 1.5 pound. So total market value is 33750. Then you will receive the cash for every 2 shares, means 15,000 divided by 2 at a market value of 2 pound. So total cash is 15,000 pound. Again, QCBs you are receiving same for every 2 share. For every 2 share means 15,000 divided by 2 into 2 pound cash you are receiving. Again 15,000. Now make the total of the market value table 176250. Next step, percentage you have to calculate. Percentage means ordinary share market value divided by total market value. 112500 is market value of ordinary share divided by total market value is 176250 into 100 is equal to 64%. So it means ordinary share market value is 64% of total market value. Same, just like 33750 divided by total, it is 19%. Next, 15 divided by total, I am rounding it off 9%, and the next 8%. Both are same, 15, 15, but first 9% I round it off. So, okay, that is allowed, no problem. Now the third, cost. You know, the shares treatment already we have discussed in the table. Shares treatment is old cost will be the cost of new shares. What is the old cost? Before takeover, what is the old cost of old shares? 45,000. This old cost you have to apportion between the new holdings, new things, which you have. New means at the time of takeover, which new things you are receiving. So 45 is the old cost. 45,000 into 64%, 28800, apportion it to ordinary share, and 45,000 into 19%, 8550, 45,000 into 9%, 4050, and 45 into 8%, 3,600. Okay, next, you know, the share treatment is always calculate the base cost, mean no gain, no loss at the time of takeover. Only calculate the cost of the ordinary and preference share. But the cash treatment is quickly calculate the gain and pay the tax at the time of takeover. And QCB treatment is calculate the gain but freeze it at the time of takeover. So firstly, we will calculate the gain on cash at the time of takeover. Disposal proceed market value from table, it is 15,000. Less cost of cash, 4050. And gain on cash, 10950. You have to pay CGT immediately on the gain on cash. And QCB's gain we also calculate but freeze at the time of takeover. QCB market value is 15,000. Cost is 3,600. And gain on QCB is 11400. But we have to freeze this gain until disposal of QCB, right? Whenever you will sell these QCBs in future, this gain become chargeable. So that is a situation in 2007 at the time of takeover. Now the third step, later disposal. Which things you are selling in 2014? 2014 means after 7 years we are now selling these shares, these things, which we received in 2007 takeover time. Now in 2014, we are selling it. So we are disposing the ordinary share, disposal of ordinary shares. In 2007, total, how many shares, ordinary shares you have received at the time of takeover? Table, see the table. How many shares you have received at the time of takeover, ordinary shares? Have you done the question? Are you writing?
5 ordinary shares.
Yes.
5 means for every 2 for 5. So total,
So 37,500.
37,500. And the cost of these shares is base cost.
20,800.
28,800. So now you are selling the 10,000 shares. So disposal proceeds, 10,000 shares you are selling for market value of 30 pound. So 300,000 is the disposal proceed. Less cost. You also need the 10,000 shares cost. At the time of takeover, total shares 37,500 you have received, and cost of this share is 28,800. We need 10,000 shares cost. So apportion it. So 7,680 is the cost of 10,000 shares, and chargeable gain 2,92320. You have to pay CGT on it now. And now in 2014, you are selling the QCBs, disposal of QCB, loan notes. In 2014, when you sell it, there is CGT exempt, because QCB is an exempt asset. Exempt means no gain, no loss, no CGT. No loss means no loss reliefs available, because CGT is exempt on it. But another paragraph, in 2007, at the time of takeover, the gain you freezed now become chargeable when you sell the QCBs. So frozen gain at the time of takeover is chargeable now. How much gain will be chargeable? Because you are selling 500 QCB. Total 11,400 freezed gain against how many QCB? For every 2 shares, you will get the 2 pound QCBs. For every 2 means 15,000 divided by 2 means 7,500. You have a gain of 11,400 on these QCBs, and you are selling now 500 QCBs. So the gain chargeable is 760 pound. You have to pay CGT on this gain. And if, for example, you are selling all the QCBs, so all 11,400 will become chargeable now. Okay. So whenever you will sell the QCBs itself, these are exempt assets from CGT. No gain, no loss rise. But frozen gain, previously which you freezed, now become chargeable.
Chargeable. Yeah.
Any problem?
No.
That's it. That is a takeover topic. Clear? Easy topic.
No.
Sequence, you have to follow the sequence. Always firstly old situation before takeover, which old things you have, then takeover, and then later disposal. Okay.
Okay.
The next topic is principal private residence. Obviously, principal private residence means the main residence in which you are living. Principal private residence means the house in which you are living, your main residence, principal private residence. When you sell this main residence, sell it, you will get the principal private residence relief, right? Through this relief,
Yes.
your house gain will be exempt. How much gain will be exempt? It depends on period of occupation. Period of occupation means in which you are occupied, living in the house. In which period you are living in the house. Occupied, you are occupied. Okay. So, when principal private residence relief is available, the formula is PPR relief is equal to gain multiply period of occupation divided by total period of ownership. Clear?
Yes.
Through this formula, your gain of the property, the main residence, will be exempt and the remaining gain become chargeable. What is the meaning of period of occupation?
How many days the person lived in the house or the flat or the property?
Period of occupation means there are two types of period of occupation. Number one, actual period of occupation.
That was deemed.
Actual period of occupation. And second, deemed period of occupation. Actual means in which you actually living in the property or house. Actually living in your house. That is actual period. And deemed means you are not living, but you are assuming. Deemed means you are assuming that you are living in the property or house. Okay. So which periods are deemed occupied that you are not actually in the house, but you are assuming you are in the house? Deemed period are first last 18 months before sale of the house or property. Today you are selling the property house. Last 18 months, always assume that you are living in the property. Maybe you are not living, but assume last 18 months you are living. Okay. And second, which period is deemed? The three periods are also called deemed occupied. Which? Number one, 3 years for any reason you are not in the house. Second, 4 years for UK job. Due to UK job, you are not in the house for 4 years. And third, any period for overseas job. Overseas job.
Yeah.
So write down, I will tell you. In these three, 1, 2, and 3, these absent periods, before these 3 periods, you actually live in the house. And after these absent periods, you actually live in the house. Before and after, actually, you must have to live in the house. Then these 3, 1, 2, and 3 absent periods are considered as deemed occupied. First, 3 year for any reason. Any means other than job. Any reason you are not in the house. Other than job reason. There are many reasons other than job in which you are not in the house. For example, you are going for holidays. Okay, and you are absent in the house for 3 years, then you can considered as this period deemed occupied. 3 years you can consider it as a deemed occupied. Maybe you are not living in the property, but you can say you are living for 3 years. But the condition is before going, actually you are living in the house, and after 3 years, anytime you have to come actually live in the house before the sale of the house. Okay. So when you go from the house, you are absent. 3 years you will consider as deemed occupied, but the condition is before this absent period and after this absent period you have to actually live in the house. Then this absent period is also called deemed occupied. Second, 4 year for UK job. Your house is in London, but you are going for job in Birmingham, but you are in UK. Okay. So your house is in London and you are going for job to Birmingham. 4 years if you are absent from the house, it will be considered as deemed occupied. But before going, you must actually live in your house. And after that period, you must actually live in the house anytime. So this 4 year absent period is called deemed occupied period. Okay. Third, any period for overseas job. Overseas job means, for example, you are going to Dubai for job purpose. Any period, for example, for 10 years you are going to Dubai, for 20 years, all this period is deemed occupied. But before going to Dubai, you must actually live in the house. And after coming from Dubai, you must actually live in the house before sale of the house. Then this absent period is called as deemed occupied. Got my point?
Yes.
Any reason means other than job. Any other reason. Just write down a question. Mr. M bought a house on 1st August 1992 for £50,000. He lived in the house until 31st July 1992. He then moved abroad to work as self-employed engineer until 31st July 1997. Next, Mr. M went back to live in the house until 31st January 03. He then moved with his sister Next, Mr. M sold the house on 31st July 2010 for £1,80,000. Your requirement is calculate the chargeable gain. Done?
Yes, ma'am.
Okay, you have to read the question and we will do it now. So, Sajia, you have to read. When you are reading the question, then you will tell me in which period you are living in the house and in which period you are not living in the house. Okay. So now start.
Okay, Mr. M bought a house on 1st of August 1992 for 50,000.
So which dates you are reading, I will write here. You purchased the house on 1st August 1989. Next.
Yeah. 1992.
1992. No.
Yeah.
I bought the house. Oh, please correct it. I bought the house on 1st August 1989.
1989.
1989 you bought the house. Okay, make the correction. Okay, next.
Okay, 1951. Okay, he lived in the house until 31st July 1992.
You lived until 31st July 1992. It means you actually living in the house. Actual period of
Yes.
occupancy. So make the 3 columns. Occupied month column, occupied month, absent month, and total months.
Yeah.
That period is 36-month period and you are actually living. So occupied month column, write down this 36. You are occupied in the house. Next.
Okay. Then he then moved to abroad to work as a self-employed engineer until 31st July 1996 or 1998?
1997.
1997, yeah.
Yeah, 31st July 1997. It means on the next day you moved. What is the next day? 1st August
1st August 1992.
1992 to 31st July 1997.
1997.
Abroad for work
Yeah,
purpose.
sorry.
You know, when you
Yes.
abroad for job purpose, all the period, any period is called deemed occupied.
Deemed occupied.
Month. So write down in the occupied month. Period.
Occupied 6.
Next.
Yeah. Okay. Then Mr. M went back to live in the house until 31st January 2003.
So it means from the next day, 1 August 1997 to until 31st January 03.
January.
Actually living in the house.
Yeah.
66-month period you are actually. So 66 in occupied month period. So it means which period I am assuming that I am deemed occupied 60 months. Before this period and after this period, I am actually living in my house. That's why this 60-month period is deemed occupied.
Yeah.
If after 60 months you will not come back in the house and you will sell the house, then this 60
It's
months
absent.
Absent.
Yeah.
Okay. Otherwise, now you are coming in the house, actually living in the house. After this period, 66 months you are living. That's why this is deemed occupied. Next.
Yeah. He then moved with his sister. Mr. M sold the house on 31st July 2010 for 1,80,000.
After this date, the next day is 1 February 03. You move to your sister house. And after that, you will sell the house on 31st July 2010. Sale date. So it means all this period is absent period, 90
absent period.
You know, before sale, last 18 months are always deemed occupied.
Deemed, yeah.
And the remaining 72 are absent period. So total, make the total of the 3 columns.